One of the most important investing skills today isn't knowing what to buy, it's knowing what not to care about. That might sound backward, especially in a world where we're constantly told to stay informed, stay engaged, and react quickly to what's happening in the markets. But here's the problem. It has never been harder to focus as an investor. Prices update in real time on your phone. Headlines refresh by the minute. Everyone has a confident take on what's coming next and why it matters right this second. And my sense is that all of this hasn't made people better investors. If anything, it's made decision making worse. You know what Warren Buffett says? He says an investment portfolio is like a bar of soap. The more that you handle it, the less you have. When everything feels urgent, when everything is framed as really important, it becomes almost impossible to tell what actually matters and what simply wants your attention. Over time, I've come to believe that one of the most underrated investing skills today has nothing to do with analysis or prediction. It's what I call selective indifference, learning what not to care about. I had to learn this the hard way. The more time I spent watching prices, looking at headlines, and absorbing other people's certainty, the worse my decisions became. Not better, worse. Eventually, that forced me to confront something that was really uncomfortable. The edge wasn't going to come from knowing more. It was going to come from tuning more things out. So today, I want to walk through a handful of things investors spend far too much time worrying about, and why in most cases, you'd be better off ignoring them entirely. One of the biggest distractions is short-term price predictions. Anything under a year should probably be discarded outright, and even a one-year forecast is often questionable. Every year, very smart people roll out confident outlooks, clean targets, tidy narratives, precise numbers, and every year, reality takes a very different path. Those misses aren't harmless. They anchor expectations, they shape your positioning, and they quietly pull people into decisions driven more by someone else's confidence than by their own plan. The real problem isn't that predictions are wrong. That's inevitable. It's the false precision they create. Short-term forecasts give us the illusion of control in an environment that's defined by uncertainty, especially in markets where sentiment and liquidity and the narrative can overwhelm fundamentals for long stretches of time. What I've noticed both personally and professionally is that the more weight someone gives to near-term predictions, the more reactive their behavior becomes. At that point, the forecast isn't informing a strategy, it's replacing one. Another thing investors get trapped by is other people's conviction. And I don't mean analysis, I mean their confidence, the certainty, of course this is obvious tone, the absolute language that shows up across every asset class. You should never buy or sell something simply because people you respect sound deeply convinced. You need to arrive at your own reasons, because if you don't, the first real drawdown or narrative shift will test that borrowed conviction, and it almost never holds up. Conviction's contagious, which is exactly what makes it dangerous. When someone sounds sure enough, it becomes easy to outsource your uncertainty to them, even if your time horizon, your risk tolerance, and your goals are completely different. Over the years, I've found that the louder and more absolute the conviction, the less useful it tends to be. Frameworks matter more than certainty. Incentives matter more than confidence. Positioning matters more than tone. Certainty feels good, but it's rarely a substitute for a process. Another major distraction is worrying about what an asset is supposed to be doing. And you hear this all the time. If inflation is up, then this should be up. Most recently, it's been a discussion around gold. If rates are falling, then this should be down. If growth is strong, prices should follow. And when those relationships break, even temporarily, people get really frustrated. They doubt themselves, and they often make poor decisions. Markets don't move in clean cause and effect chains. Different assets absorb the same conditions on different timelines, sometimes really quick, sometimes really, really slow. The mistake is assuming that everything should move in lockstep. When expectations become rigid, positioning starts to break down. People stop responding to reality and start reacting to disappointment. A better question than "why isn't this working yet" is often simply, "what is this actually telling me right now?" Another thing investors tend to overweight is event-based thinking. Policy announcements, elections, data releases, big calendar moments that are treated like on-off switches. The assumption is that once the event happens, everything should change. But markets rarely work that way. By the time an event arrives, expectations are often already baked in. It's why we came up with the phrase, "buy the rumor, sell the news." By the time an event arrives, expectations are already baked in. Positioning is crowded. The story is widely known. What matters far more than the event itself is what happens afterward, how capital flows, how incentives shift, and how participants adjust to things. It's much more useful to think of big events as slow-moving structural changes rather than instant catalysts. They matter over time. Obsessing over launch dates, first-day reactions, or immediate price moves usually doesn't. This is really the common thread in all of this. If you're looking for even more clarity, that's what See the Forest Delete is for. This is where I go deeper, speak more directly, and focus on what actually matters without worrying about headlines, algorithms, or clickbait. At See the Forest Delete, you'll get access to members-only videos that aren't on the public channel. The Members Elite tier is just $9.99 a month. Hit the join button to enter. I'll see you on the other side. And now back to the video. Most investing mistakes don't come from not knowing enough. They come from caring deeply about things that don't actually deserve emotional bandwidth. And once you realize that, the goal shifts. It's not about finding the perfect investment. It's about building a process that helps you ignore the right things. Closely related to this is the way investors treat headlines as binary outcomes: bullish or bearish, green light or death sentence, good news or bad news. A comment leaks, a proposal's floated, a decision is delayed, and suddenly the entire long-term outlook is supposed to change in a single news cycle. But most real-world change is slow, it's messy and incremental. It happens through half steps, compromises, adjustments, and revisions. Paying attention to direction matters. Reacting to every quote, rumor, or procedural hiccup usually just creates whiplash. If your portfolio needs to be rethought every time a headline crosses your screen, the problem isn't the news, it's the structure of your portfolio. Another phrase that tends to appear when expectations break is, "this time is different." And to be fair, sometimes things really are new. New access, new products, new structure, new participants. Where people get tripped up is using novelty as a reason to throw out history entirely. Most of the time, "this time is different" shows up after reality disappoints expectations. Instead of asking what's changed structurally, people reach for narratives that conveniently explain why old patterns no longer apply. In my experience, that framing usually says more about emotion and positioning than pure insight. The tools evolve, timelines compress, labels change, but greed, fear, and impatience have remained markedly consistent. Ignoring history entirely is rarely an edge. Another trap that investors fall into is caring too much about beating someone else's benchmark. An index, your best friend, some fund manager, an account they follow online. Those comparisons feel objective, but they rarely reflect whether your portfolio is actually built for your life. Time horizon matters. Your risk tolerance matters. Your liquidity needs matter. Your constraints matter. None of that shows up in a benchmark. When people fixate on relative performance, decision-making starts to warp. They tend to take risks that they don't need to take. They abandon positions too early, before they get a chance to really run. They chase exposure that doesn't belong in their portfolio simply because it's working somewhere else. The real objective isn't outperformance in a vacuum. It's building something that you can stick with through good periods and bad. Now, to be clear, benchmarking does have a place, but only in a limited, disciplined way. If you're testing a new strategy or experimenting with a more active approach, comparing yourself to a broad market index over a period of years, that can be useful. If the extra effort, complexity, and the risk aren't producing better results than simply participating in the market, that's often a signal in itself. But that's very different from day-to-day scorekeeping. So if there's a takeaway here, it's this. Most investing mistakes don't come from not knowing enough. They come from caring about too many things that don't actually matter. Selective indifference isn't about ignoring reality. It's about filtering it. It's about knowing which signals matter for your plan and which ones are just noise trying to hijack your attention. And in the long run, that tends to matter much more than finding the next thing to buy. If this kind of thinking is helpful, focusing less on predictions and more on decision making, that's exactly what I try to do here. Not hype, not forecasts, just clarity around how money actually works. Now, if you're watching this and thinking, I'm doing okay, but I'm not sure that my plan is exactly built around me, well, that's exactly what I help people work through. And if you're not ready for that yet, watch this video next. It builds directly on this idea and helps connect the dots between ignoring the noise and making better long-term decisions with your money.